Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
There is the pageantry of a president in the United Kingdom. This is without question of our interview of the morning. Tina Fordham joins us, founder of Fordham Global Foresight. Tina, I read the obligatory BBC summary of what we're going to see, and it's a full court press. I mean, the president will visit the tomb of the late Queen. He'll be greeted by William and Catherine and the rest, and all the pageantry as well. How will the United Kingdom greet President Trump?
Well, before we go there, can I just confirm the Lime bike race and the tube strike in London?
I was hoping you would.
Yes, and I'll pass on the boo-boo madness, but yes, I personally know many Lime bike virgins who had to come to grips with it.
Well, let's pause. We can get back to the president in a moment. How long is this idiocy going to go?
Indefinitely. And I tried to go to the theater last night, and it involved 90-minute expeditions planned with military precision. It has really had a huge impact on business and everything else. We don't hear anything about talks. And what's really annoying people here in the UK is that the drivers are striking for a 32-hour work week.
Right.
And many of us with those investment banking 92-hour work weeks that you guys were talking about find that a bit irksome.
Tina, Lisa from New York says, ask her, Tina, are you wearing a helmet when you're in the bicycle battles?
I didn't say I was riding the Lime bikes.
Oh, okay. A little confusion.
And also, no one wears helmets on Lime bikes.
Right.
It's not the done thing.
Tina, let me turn back to you. And a few days ago in my inbox landed an email from someone else who charts geopolitical risk. That's Ian Bremmer of Eurasia Group. And the headline was From G7 to She3. And of course, Ian Bremmer made his name most recently by coining this term G0, suggesting that a lot of geopolitical alliances were shifting and changing. I'm curious, picking up on what he wrote, how you thought about what we saw unfold in Beijing a few days ago. President Xi there greeting the leaders of North Korea, India, Russia. What does that signal to you, if anything, about the way that the geopolitical terrain is shifting or not?
Well, the Shanghai Cooperation Organization summit was spectacular. There's no other word for it. The military kit that China had on display was, both impressive and intimidating, depending upon where you sit on the globe. And the optics, of course, of that, triumvirate of Xi, Putin, and Modi was very striking. But I do not buy the tripartite world idea. And you can already see that, Modi and Trump are kind of, looking to make up a bit. I think it's something much more nebulous than that.
On this note, there was a story this morning about China and Mexico's relationship, and China through its commerce ministry delivering a stern message to Mexico about a unilateral tariff increase by Mexico, even with the framework of WTO rules, would be seen as an appeasement and compromise toward unilateral bullying. Could you frame that out for us? The way that we have seen China respond to this trade war, not on a bilateral basis vis-a-vis the U.S., but with other countries in its orbit, and what's the message that it's trying to send here to Mexico with that announcement today?
Well, let's put it in perspective. I mean, throughout this kind of 9 months where we've had this huge effort by the Trump administration to put forward an overhaul of America in the world, both from trade and security perspective, China's been quiet. It has been able to watch, to observe, to occasionally signal where it stands with power, but it hasn't really risen to the bait. It is perhaps, unique among the world's largest economies in that it still has this pause going on the Trump tariffs. So that, strategic patience that we see from China is very much in evidence. The comments that you're talking about, to me, reflect how we are still seeing a great deal of international trade. And in fact, I would say globalization continues, but it is following different channels and excluding the U.S. increasing.
I'd like to stick with trade for one more minute, if I could here. And I'm curious about the conversations that you're having, Tina, with executives, with your clients at Fordham Global Foresight, what they're telling you about the way that they're finding their way through this now. I think there was that period, certainly after the president's trade policies were announced at the beginning, where we were all kind of fumbling, trying to figure out what they meant and what would stand. Of course, there's the ambiguity here of what's going to hold up in a court of law going forward. What are they telling you about their confidence in, yes, the way these policies are going to stand, but how they're going to be able to kind of plan and do business with them in place?
So our clients, I think, have kind of gone through the stages of grief with the previous status quo relationship with the United States and indeed the global trade system. And after several months, I would say, of a real chill evident in the C-suite, in corporate America and indeed the rest of the world, I've seen a real increase in risk appetite and also just kind of getting on with things and finding, new opportunities and ways to make deals. So I think you also are starting to see that come through in the M&A numbers, for example. And, markets for their part are bullish. Corporate earnings haven't been hurt by all of this. But I think there's more energy and more creativity going into, finding new ways of doing things.
Right. Tina, let me get this in as we talked about the joy of a strike in London. We were mentioning President Trump's visit next week. How will he be greeted in the United Kingdom? Obviously, there'll be the usual protests, I'll say, but I just find it remarkable the character of the greeting our president will receive.
I suspect that Downing Street will be very careful about President Trump's potential encounters whilst he is here. Going to Windsor Castle, seeing the Queen's tomb, which I've seen, by the way. It's really something to behold, as is Windsor Castle. I think the emphasis is going to be on the good links that exist. But of course, in the background is going to be the fact that the UK ambassador to Washington, Peter Mandelson, was sacked. I saw that he's just been fired from the consulting firm that he works for. And that's an embarrassment not only for Keir Starmer, but for President Trump. It suggests that the Epstein files are real.
Tina Fordham, thank you so much. And a major shout out to our team, Max Abelson and all, who did the investigation of the Bloomberg News essay. I really urge you to skim it. It's a very long effort. How 18,000 emails?
They obtained 18,000 emails from Jeffrey Epstein's personal email account, and in that correspondence were emails between him and Mr. Mandelson. So, and
that with Ava Benny Morrison as well. Look for that as that story unfolds into the president's trip to the United Kingdom. We'll, of course, have complete coverage of that. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
The important economic conversation into the weekend. It is with Claudia Sahm. She's definitive out of Ned Gramlich's University of Michigan Economics. A tour of duty at the Fed, without question 2 years ago, the nation's economist of the year in academics with the Sahm rule and all. Claudia Sahm, not is she so kind to us on Jobs Day, Claudia Sahm, not on the Fed Day, but Claudia Sahm on your American recession. Claudia, is the Sahm rule clicked in here as we saw that revision to the jobs report?
No. The revision to the jobs report was about payroll employment. It had no effect on our estimates of the unemployment rate. It was the case last year where those revisions to employments are relevant, that the unemployment rate was rising. So I'd say that the revisions paint a more consistent picture of the labor market, right? The unemployment rate had risen enough to trigger the Sahm rule. And we now know that the payrolls, they'd slowed. And in fact, they'd slowed even more than what we had thought at the time. So it kind of more in harmony together, I guess.
With the dynamics of where we are, particularly with immigration, is a 4.3% unemployment rate what used to be a higher unemployment rate? Can you say that?
So the unemployment rate that we could kind of settle into when things are good, it does move around over time. I think one reason we see unemployment rates that are quite a bit lower than, say, decades ago, 4.3% historically is quite low, is that we have an older workforce. Workers who have more experience tend to, move in and out of jobs, lose jobs less frequently. So I think a lot of it's demographics where we're at kind of this lower unemployment rate. And that's why when you're trying to think about where are we headed to a recession? Are things really going south? You look at changes in the unemployment rate as opposed to a particular level. Like that's such an important, and we've seen in recent months the unemployment rate nudging its way up, still slowly, but moving in the wrong direction.
Behold the shifting balance of risks, and I want to ask you about that and the Federal Reserve's capacity to deal with it. And I look at the most recent Bloomberg survey of Wall Street economists. There's this expectation here that the language is going to change from the Fed chairman when he speaks on Wednesday about the labor market and the condition that it's in. What is your sense of this Federal Reserve's capacity to deal with the shift here more toward the labor markets? It seems it's going to be the case. And as Tom and I were mentioning just a moment ago, we're at a point here where we really don't have a full grasp on the personnel around that table on Tuesday and Wednesday. That's still very much up in the air. Perhaps a basic question, but does that color the conversation that's going to take place there on Tuesday and Wednesday at all?
The conversation and the rate decision is going to hinge on the data. And the Fed they are grappling with a really tricky environment in that inflation's too high. Like it is not, and it's not moving towards the Fed's target right now. And then you have employment that has really softened. I mean, it might be structural, it might be immigration, but it might not be. It might be demand is really slipping. And so the Fed's got one tool and they've got two problems that are going in different directions. So they're going to have to frame up and really assess from the data which of these two risks is bigger and more persistent. I mean, that's the way the Fed has outlined that it approaches this. That's how they're going to do it next week. But I mean, the reality is this is not going to be a normal FOMC meeting, right? There's a lot, and frankly, it may matter more for the inflation outlook, the rate outlook, not just next week, but going forward, who actually is sitting at that table and voting. Because it will be a big change in Fed policy if Lisa Cook is not there.
Claudia, one of the magical things you had was a tour of duty with Matt Shapiro at Michigan. He, folks, did more on inflation research than anyone I can imagine within academics. I've been talking a lot, Claudia, in my stilted way, about the substitution effect. Is it in place now with this new bout of inflation? Lisa, help me here. Joe Weisenthal had beef prices up, banana prices up,
coffee
prices through the moon. Claudia, is it normal Sahm economics now as we substitute and try to get to Monday with our diminished purchasing power?
Right. So, I mean, it's a basic reality of economic behavior. I mean, people they're going to react to prices. That's why we have prices. It tells us something about what's scarce and what's available. And so there absolutely should be seeing some adjustments, but we have to be, real about the extent to which people can make substitutions. Right. There are, housing is a very expensive for many Americans, and it's also a necessity. Right. So there is a process of adjustment going on. Some of our inflation statistics capture that substitution in real time better than others. But I think we also shouldn't I would also push back on some of the discussions around tariffs where it says, it's a relative price change. The tariff goods, their prices go up. So then people just shift to something, shift away from that. And then inflation overall doesn't go up. I don't think that's the read that we get out of the data. Inflation is stalled out and is moving ever so slightly higher. So I think substitution is there, but there are limits to how much people can deal with these price changes.
Tom has talked about the perniciousness of inflation, talked about the stickiness of inflation. I want to just pick up on something you said a moment ago, which is the role that tariffs and trade policy is playing in all of this as you kind of assess the gumminess, the glutinousness of this inflation. How much of that has to do with trade policy uncertainty thereof?
The trade policy is not helping in the sense that we do see goods price inflation picking up some. But honestly, the thing that we're dealing most with inflation is on the services side. And that's a stickiness that we came into this year with. Like that last mile on some of the services, including non-housing services, it's been tough to get the traction in that last bit. And, while inflation is not, 3% inflation versus 2% inflation is not like what we were dealing with in 2022, like where that was much bigger, but it adds up. I mean, these are price increases happening month after month after month. Like it does cut into disposable income and into people's purchasing power.
Claudia, let's finish up with this. I think this is a huge deal. Okay, we go back to the 60s and 70s, and most people today can't remember Walter Heller, and everybody hysterical about 5% inflation, whatever it was at the time before the Volcker surge. Now we're nuancing between 2 and 3%. I think of John Taylor out at Stanford, many others, maybe McTeer in the Texas Fed, being cautious. We have to be at 2%. 1.8% would be better. For Claudia Sahm, to our listeners and viewers, is 2% that much different from 2.8 or 3% inflation? In any given month, no, it's not. But it does add up over time. And also, I think it is this very point about, like, let's keep things in perspective. That is very relevant for the decision the Fed's going to make next week. Because we're thinking about what's the risk of, like, in a recession, the unemployment rate doesn't just nudge up. The unemployment rate goes up by percentage points, multiple. And we have this issue of inflation seems to be stuck closer to 3% than 2%. So like you're balancing off which of these two is the bigger problem. And it's that keeping it in perspective, I think, that lands you on the side of, no, the risk here is a bigger risk on the employment side. Claudia Sahm, thank you so much. Thank you patiently for waiting for us as we spoke to Miles Miller and Terry Haynes. She's a huge force here at Surveillance. Can't say enough about her courage to confront the nation's economics. Claudia Sahm, we hope to see her at 8:30 on the next Jobs Day. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube. Joining us now, and hugely timely, it's always lovely on a Friday to speak to Robert Teeter. He joins us today from Silvercrest Asset Management. But in the oddities of halfway through September, it's strange. 2 weeks ago, 17 days ago, Robert, endless stories about seasonality. Woe is me. September is terrible. Why are we going up with a bid in the market? The Japanese market record high, the Dow record high yesterday. Explain why, given seasonality gloom.
Well, typically when everyone gets back to their proverbial desk in September, they start to look at all the problems that they missed in August. And this year you've had a different configuration, which is if you start paying attention to the fundamentals, the backdrop has actually improved. The last quarter earnings season was well better than expected. The outlook for the Fed is well better than expected. We look at rate expectations for June of 26 as kind of a focal point. And that's come down over the course of this year from 3.9 to 3. So that helps you on the valuation side. That earnings season, big surprise. The earnings season. Fantastic earnings season. The stock market, David, I don't know if you're aware of this, but the stock market equation has two expecteds on each side of the equal sign. We're expecting out, Robert Teeter, and we're like modeling in. We're guessing a good earnings season. Guessing a good earnings season. I think the remainder of the year, kind of mid to high single digits. The thing that has really interested me is that almost every quarter, if you go back over the past few years, you've had analysts doing a great job estimating revenue and underestimating on the earnings side. And to me, that's really that productivity story that just continues to build. So we look at margins now versus margins in the few years leading into the pandemic as kind of a comparison of normal to normal. They're higher now. A couple of sectors at peak margins, other than the very disrupted quarters. They're getting the job done.
Did you notice Robert Gurry has his own technical staff?
Impressive. I need that.
What's great, and they all have like single names. Like Brockton just came in. Brockton has dugout seats for Red Sox Yankees this weekend. I mean, that's how they're rolling.
This is why I don't have an AI agent. I don't need one.
Are they union? I mean, it's amazing how I don't have a technical staff. What was wrong with your computer?
I didn't have the clock up. I didn't know how long.
You didn't know where we were.
That, a sense
it's
of where
Friday
we are in the
morning.
Show. I don't want to just fumble through all of this.
Ladies and gentlemen, David Gurr.
You use a word that I've kind of been keeping track of over the course of the week, and that's stagflation.
Yes.
You're not shying away from using it. And help you have me understand sort of how you're thinking about that in the context of, I was talking about AI agents a second ago. How do you see that in this kind of broader context of AI and productivity and sort of where we're headed?
Yeah, I think it's a very important issue. It's popped up a lot the last couple of weeks just because of the direction of the data. So on the stag side, the labor market has seemed a bit weak. And on the inflation side, you continue to see the numbers ticking just a little bit higher. So definitionally, people are starting to talk about stagflation. But I think when you separate those two factors and you look through, the AI theme really is playing out on both sides of that equation. A lot of the labor market staleness, let's say, I think, is companies lagging headcount because they can be productive. And on the inflation side, I think the numbers aren't as bad as projected because companies are adapting.
Right. Heath Terry in yesterday from Citigroup, but he was heated that the thing they learned at their tech conference was the speed that this AI thing is moving at, David.
Just fascinated by one other line from that note, that is that AI is likely helping to mitigate the inflationary pulse from tariffs. Question we've had over the course of the week is sort of what we know about the effect that AI is going to have on productivity. How confident are you? What sense do you have of the weight it's going to have, how it's going to improve things, and sort of the weight it's going to have on the labor market broadly?
Well, there's not a whole lot of great data now, but everything that we've seen, every study that we've looked at indicates that there is the potential for significant labor savings. And pretty much every company that's been willing to talk about it has mentioned that as well, but done so in a very cautious context of not we're replacing labor with AI and laying people off, but rather we're going to grow with slower headcount. And I think that's a really positive trend for earnings. But the impact on inflation is similar. When you get the tariff increase, you have a few options of what you can do. You can pass it on, you can eat it in margin, or you can go back and say, is there something else we can do to become more productive and offset in other areas? And I think that's what companies are doing.
Robert Teeter, Silvercrest with us. We continue with him. We welcome all of you across the nation on this 12th of September. Good morning, 99.1 FM in Washington. Thanks to our Washington team, Meishi and all, for their assistance yesterday on the 11th of September. Good morning, 92.9 FM in Boston. On YouTube, thank you for the kickoff of September. Just wonderful growth there as well. Subscribe to Bloomberg Podcasts. What do you make is an equity animal of finally yield curve compression and real rates, inflation-adjusted rates, the residual. It's a calculation, folks. We're not doing math on Friday. But finally, the real rate comes in.
Yeah, I think it's hugely supportive to valuation. So the way I look at valuation is number of factors that influence inflation, interest rates, sentiment, domestic policy, global policy. Interest rates a key input to that equation, of course. As that expected rate has come down and we're looking for rate cuts, that gives you a lot of support on the valuation side, a lot of comfort to be able to look forward and say, we've got maybe a little bit of a tailwind to the economy, and from a classic valuation asset allocation standpoint, lower rates, higher valuation. I think that's a big plus. It's something that has maybe gotten a bit stretched in that even if you take out the 90s, we're sort of at the high end of normal valuation ranges right now. We counted at about the top 8% overall versus a long-term history, and those higher numbers are the 90s. So we're perhaps a bit stretched on that metric. Further gains, I look to earnings.
We've got Tracy McMillian of Wells Fargo in the wings. She writes about small caps. You write about small caps. Let me set up here a debate among the two of you, I guess a debate by proxy. You see this as a moment when they are going to become something investors should take a closer look at.
I do. There have been a number of catalysts that we've been waiting for a while. Back at the end of last year, it looked like those catalysts were starting to play out. They got delayed quite a bit, mostly because of the noise around tariffs. First and foremost is interest rates. There's two benefits to small caps there. One is the interest rate cost that they have to pay, and the second is the willingness of investors to participate in the space given expected economic growth. Small caps do better when growth is expected to improve. The second is M&A. M&A, really came out flat this year, has started to pick up quite a bit in the past few months. That helps small caps a lot. They're the target of those acquisitions. And then lastly, I think these trends in productivity started out in large cap, and they will spread to small cap as companies start to figure it out and the costs come down. So I see those three catalysts starting to play out into the course of next year. Small caps have gotten a pretty nice bid here the past few weeks, and I expect it to continue into next year.
They're up 30. The ETF, the Russell 2000 ETF's up 32%. From like early spring, like 3 cups of coffee ago.
Yeah, it's been lagging for years. So I kind of look at that first move as the catch-up move, and now it's time to get the job done.
Well said. Robert Teeter, thank you so much. With Silvercrest Asset Management. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's do the newspapers. Lisa Mateo here. Lisa, what do you have?
Okay. David, are your kids teen years yet or not yet?
We're on the cusp. I feel it coming, though.
I feel it coming.
We're looking for the first girl of gray hair.
Yeah. I'm waiting. Do they do hauls? These things that the kids do on social media?
I have heard of this term.
Yes.
I confess I don't know what it is exactly.
Okay,
Enlighten me.
Let me explain. Okay, so this is when teens go out, right? They do their shopping, they come back, and they post videos about all the stuff that they bought. Actually, their parents bought.
There you go. Important clarification.
Clarification on this. So this is about back to school hauls and how they've come to another level. Kids are spending, their parents are spending hundreds of dollars because these kids want to post all these videos. And it used to be like my daughter did it. It was Target, TJ Maxx, yay, And now they're doing designer clothing, expensive beauty products, trendy backpacks. They're spending like $700. And they do it because if these videos go viral, then the kids get these branding deals, and companies send them the free gifts.
Influencers.
And maybe they get that $68 Lululemon shirt for free.
For free,
perhaps.
Yes. Or
We've
maybe
debated that. We talked about the Lululemon
t-shirt. Things in the pack you talked about yesterday. The
little Labubu's.
Labubus.
Oh.
And they're out now, you say?
Yeah, they're out. They're not as popular anymore. They're going down. But apparently, people used to post about those too. So it was kind of like that thing, doing their Labubu haul. Not
maybe
anymore.
You should do a haul video on LinkedIn, Tom.
Yeah, I should do a haul video.
I actually did a Costco haul once. It was fantastic.
Yeah? This bow tie I found buried in the stack this morning. This was back when Mr. Hermes, it was like just horses, like in the 19th century.
He made it himself.
We're still wearing it.
Yeah.
It's like ancient. Next.
He has to do the bow tie haul. Okay. So we've heard about a lot of stories about AI startup companies, right? But the Wall Street Journal says the life of an AI founder, it's not really glamorous. It's no sleep. It's no booze. It's no fun. So they spoke to a couple of AI founders, mostly in their 20s. They basically live with their laptops. And they said, one guy said he put in 3 92-hour weeks in a row. He went on vacation once. He wants to build this $10 billion company in 10 years.
That's called investment banking.
Yeah,
that's what you did.
You're not shedding a tear over
that. I get really upset about this. Yeah. I mean, how do you learn this stuff? And in AI, with the incredible coding skills they have, that's what it takes. It's not, it's not like a surprise.
And they say it's not all about the financial. They say it's like a game. Like it's this competitiveness as to who can be the most obsessed. Yes. And that's what it kind of becomes.
I got an email from Pinterest. They got something new out today. I have no idea what it is.
You're going to update your board? Your Pinterest
I have no
board?
idea.
Yeah, okay.
Not Pinterest. Excuse me, Perplexity.
Oh, sorry.
I misspoke.
Okay. I was like, he's on Pinterest.
Sorry, Ben. I've been on my mind. Next.
And the last one, this is just a look over in London, a look back at the London tube strike, right? And how bad it got, commuters struggling to get around. So they were talking about, Uber prices rising, bus lines stretching around. But the big thing were those Lime e-bikes. And it was the battle. People were fighting over these things. Yeah, I mean, it was really bad. Some people got complained. They call it Lime bike leg because it falls on you and it's like 86 pounds. And you have people who've never ridden these things. They're in their heels, their work suits. They're trying to get to work now. And they're trying these bikes for the first time. And it was just a disaster.
Well, some turmoil there and, of course, other parts of Europe as well. Lisa Mateo, thanks so much. It is the newspapers.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.